With me today from Capital Network, I've got Ed Stacey. Ed, good morning.
Good morning.
We're talking Grit Real Estate Income Group here. You've had a big report out on them this week. Tell us some of the key points here, Ed.
So Grit is a real estate company with holdings across Africa in various non-residential sectors. The thing that really interests about it as an investment is the dividend yield, more than 8.5% now. Normally when you get a dividend yield that big, you're looking at a company that's maybe perceived financial distress. You know, people are questioning the dividend. In this case though, Grit has just achieved its listing on the LSE main board and raised capital. It was previously on the Johannesburg and the Mauritius exchange, Mauritius where it's domiciled. So now 3 listings. They raised capital on the LSE. It's also a company that's paid 9 consecutive dividends in line with guidance. I don't think anyone is questioning the financial strength of Grit. Maybe what people are saying is, well, it's still Africa related, and so you need a risk premium, and that's why the big dividend yield. I think what you have to look about, though, is look at the quality of the tenant base. It's blue chip global tenants, typically long leases. The average weighted average lease expiry is 7.5 years at the moment, and it's euro and US dollar lease contracts mostly. So really, you're talking about a high quality global revenue stream, and yet you're getting paid this large risk premium in terms of the dividends.
As you say, it is Africa we're talking about, so still an element of macroeconomic risk. Is that fair?
I think macroeconomic risk is something to be aware of. I think Grit actually do a very good job of dealing with these risks. One thing is the diversification. Diversity in terms of the countries that they're exposed to, including investment grade countries like Mauritius and Morocco, as well as higher growth countries like Ghana or Zambia. Also diversity in terms of the types of building, office, retail and hospitality, which is hotels and resorts. Also diversity in terms of the types of tenant, so they don't want to be all oil companies or oil or mining companies. So diversity, diversifying the risks. Also though, in terms of contractual assurances, a lot of work done there in terms of making sure they have the right contracts and the right kind of guarantees in place. Now, an example of what tells us that this all really works is if you look at their Mozambique portfolio. Mozambique's a country which, as you know, has had some economic and political turbulence in the last couple of years. Their holdings there have actually performed extremely well through all of this. And I think what it tells you is when you have these high quality tenant base and you have the risk mitigation in place, then yes, you can ride out macroeconomic volatility. And the Mozambique example tells us that that really does work.
Grit's on a 1x NAV. You're expecting a re-rating here?
Well, in terms of the valuation, in terms of the way the returns to shareholders work, I think the way to look at it is to say it's on 1x NAV and it's paying you an 8.5% dividend yield. On top of that, you have a capital gain every year driven by the rent escalations and a degree of improvement to properties, 3 to 5% sort of capital gain. So plus your 8.5% dividend yield, it's giving you a 12% return as a shareholder. And I think that's a beautiful thing. If it was to re-rate and that NAV multiple goes up, of course you get a bonus then as well. But I think it makes perfect sense to just buy it on the valuation it's on and just enjoy the dividends and the capital gains.
Ed's full reports up on the Capital Network website. Plus, of course, you can click on the eye in the top right-hand corner of your screen. Ed, thanks very much.
Thank you.